Hi, I'm Brian with the Forex Collective bringing you another training video. There are three main categories of Forex technical trading analysis. And so with this video, I'm going to share with you an overview of each one. And at the end, I'm going to share a bonus strategy. Now let's go to my office and I'll bring up some visuals. Don't forget that this channel is catered towards the beginner Forex enthusiast. My videos will be focused on creating content for people who are currently working full-time so that they can apply this knowledge, grow their account, and eventually quit their job to have free time for the things that you love. Today we're going to cover three main categories for technical analysis: price action, indicators, and Elliot Wave theory. Now this will just be a very general overview of each one, but then later on I will be posting a series of informative videos that will go into greater detail and showing real live examples. So if you haven't done so already, please hit the subscribe button below so you don't miss out. Starting with price action, there are kind of five main price action tools that I like to use: trend lines, support or resistance, otherwise known as zones, candlestick analysis, breakout patterns, and then actual pattern formations. There are others, but these are the most used. Trend lines. So any line needs a minimum of 2 points. Trend lines can be diagonal or horizontal. And once the line is established, then quite often when price does reach that trend line, it will find resistance or support, as can be seen by the two red arrows on this chart. As the name suggests, trend lines are good for finding the trend of the market, downtrending or uptrending markets. Then to trade with a trend, you simply look for the corresponding bullish or bearish trades. In this example, the trend is bearish, so we are only looking for short opportunities. Support and resistance zones are horizontal areas that price will usually react off of. The more touches the market has on the zone, the stronger the zone. Here we have more than 5 bounces off of the zone, so I consider it a very strong one. Price will often bounce between zones, especially in ranging or sideways markets. And in trending markets, price will use the zones as a trampoline to bounce up to new highs or lower lows. Candlesticks tell us in real time what the buyers and sellers are doing. They can tell us when the buyers have showed up or the sellers have left. There are 3 main candlestick formations, and each one tells us something different. They become the most powerful when they happen on top of a zone. Doji, I like to call this bar an indecision bar. The buyers and the sellers ultimately cancel themselves out within the bar. It shows there could be a potential reversal in price as the other group is gaining momentum. Engulfing. This example shows a bullish engulfing bar. This means that the sellers pushed the price down to a new low, but buyers said that's enough and pushed price back up and made the candle close at a new high. This shows that buyers are now in control of price and to look for long opportunities. Inside bar. In my opinion, this is similar to a doji. It tells me that there may be a reversal in price. The inside bar forms completely within the previous bar. It shows in that time frame price was not able to make a new high or a lower low. Indecision is essentially happening. Breakouts, otherwise known as continuation trades, is a simple concept. As shown in this example, price makes a structural low or high, then retraces, then breaks through that zone. Once price breaks through that zone, it is anticipated to retrace back to that zone and retest it. This is when the trader would look to go short. On this example, you can see that the first arrow goes down, makes a low, retraces. That low has now become a support zone. Price then broke through the support zone, came all the way back up. That support zone is now a resistance zone. It hit big resistance and then went back down. Patterns. There are many different variations of these patterns, but here are the main 4. Double top. Price makes a high, then retraces, then goes back up to try and retest a high but fails to do so. This signifies a reversal in price. Flags. Price will have a sustained up or down trend, then price consolidates, then price breaks out and goes on to continue that trend. Head and shoulders. Just like the name, a head and shoulders outline can be imagined here. Price will make a high like the shoulder, then retrace, then go on to make a new high, which is the head, and then price retraces back down to about the first retracement, then reverses, tries to make a new high, but then doesn't, and then price will fall back down below the neckline. Triangles. There are many different kinds of triangles. It's really just two trend lines that are converging into each other, and price is getting more and more compact, spring-loaded, ready to charge out of that triangle. Elliot Wave is a detailed description of how groups of people behave. It reveals that mass psychology swings from pessimism to optimism and back in a natural sequence, creating specific and measurable patterns. Elliot believed markets will move in 5-wave impulses followed by a 3-wave correction. The 3-wave correction will most often retrace to point 4 or to point 2. Elliot Wave takes much practice as there are lots of different types of waves, and experience is key here. Indicators take past information and summarize it. This can then be interpreted to spot trades. So the first one, moving averages, simply take the price of the last however many number of bars, and you'll see if the current price is above or below that line. It can show if price is going to be trending higher or lower. Bollinger Bands are a type of statistical chart characterizing the prices and volatility over time. MACD. This is short for Moving Average Convergence Divergence. It is an indicator to show changes in strength, direction, momentum, and duration in the market. And Fibonacci. It has been proven that there are recurring numbers in nature and patterns, and they are found in markets too. Price retracements can typically be associated with the different fib retracements, 382, 5, and 618, or breaking out in fib extensions such as 1.41 or 1.6. And the last one, RSI, is the Relative Strength Index. This can show if a market is oversold or overbought. Here's the bonus strategy. Question for y'all. What would happen if we used as many of these strategies as we could to spot a setup? Do you think that we could have a powerful strategy on our hands? And we could find high probability setups? Let's see. So on this chart, it's the Australia-New Zealand pair. And so what do you see? What kind of strategies do you see? I see a possibility of 3 different strategies: support and resistance, a pattern, and a breakout trade. Let's start with the zone. This is a major zone. Price has reversed off of this zone multiple times. What other info do we see though that will show us that we should be searching for either a short or a long trade opportunity? Looking for a short opportunity. We see that there's a head and shoulders pattern that has completed, and price is now just starting to break out. So we're going to be looking for a breakout strategy. So I'll be waiting for that major zone to be broken, which is also the neckline, and then entering on the retest of that zone for the breakout strategy. Price broke out and retested the zone, forming a double top with a pin bar. This is yet another pattern showing a reversal is taking place. We can see with the blue arrows that price did break down and then came back, and that last bar shown is the pin bar. How do we enter this? Well, I find there's kind of 2 types of traders, aggressive and conservative. Aggressive would enter on the close of that doji, where a potential strategy for conservative guys could be to wait for a low to be formed and then enter at the break. So you can see the aggressive guy enters earlier, that would have a much higher risk to reward ratio, and the conservative guy waits for more price action clues before committing to the trade. So now we have our entry. How do you now place the stop and target? Well, the stop should be at the structural high. This can either be as a hit stop or a BACA stop, which stands for break above and close above. The difference means is if you enter in price goes above that structural high, you get stopped out. Whereas with BACA or BACA, price has to go above and close above. So BACA is good for avoiding fake outs and stop loss hunting. However, if you forget you don't have a stop, you can miss being at your computer on the closing candle to exit, or the losses may be quite a bit larger than anticipated. The target in this specific case for a head and shoulders pattern is a fib extension of 1.6 or 1.4, whatever the market dictates and your strategy has backtested to be a better probability. So here I show the trades for AE and CE respectively and the RR. So you can see that the risk to reward for an aggressive trader would be 4.8 and for a conservative would be 1.4, so actually quite a bit lower. So there it is. I hope you enjoyed this brief introduction to Forex trading strategies. I will be uploading specific detailed trading videos on each one of these strategies in the coming weeks. So if you haven't already hit the subscribe button, please do so now. Also, I will be releasing a signal service right away. So if you like the videos and examples that I'm showing, please shoot me a comment below.